Happy Friday, everybody. I hope everybody is doing well. Today is June 25th, 2021. And in addition to all the great things we've made it through the week. It's Friday. And so in addition to the normal summertime Fridays we've also got kids going away to summer camp. What else we got? It's time for your Friday planning video. So thanks for tuning in. We've had a big move up in the stock market since March of 2020. The S&P 500, that index that we keep track of, up almost 100% since the low print on March 23rd, 2020. Now with that move in the stock market, some individual stocks have even done better than that. Topic that keeps coming up with you and with others: taxes, capital gains specifically. So this is not only talk about with you that we're having, but the government's getting their ideas on how they can get their share of it. So let's talk about some of this. I'm publishing an article in a magazine this coming week, and I pointed out in the article that I read recently an article entitled by the name of "New Capital Gains Rates Complicate Tax Planning." Now, interestingly enough, that article could have been written today. It wasn't. It was actually written in April of 2013. So what we do know, tax planning keeps changing. Tax rules and tax laws keep changing. What we're going to do, keep planning, and we're going to keep adjusting. So please note, the information that I'm going to talk about today, it's not to be taken as personalized tax advice. You should consult with your tax advisor and myself, and we'll talk about how this can affect your planning. So stay tuned for upcoming planning videos, because as we do see some of these new tax laws come through, those will probably come in regular planning videos, or more specifically probably in special videos. So keep an eye out on those. We'll try to do our best to keep that stuff in front of you so that you know what's going on with that. So let's talk about four main ways that you can manage your taxes, and specifically the gains and you have in the taxable account. So that's a great place to start. So remember, this has to do with your taxable accounts. It does not have to do with your IRA. It does not have to do with your corporate retirement accounts, your 401ks, your 403bs. That capital gains is a different discussion. Now, if we're talking about taking profits, reallocating, rebalancing, that's still, no matter where your accounts are, taxable or non-taxable, it's something we should talk about. But when it comes to capital gains, it does not affect your IRAs and your retirement accounts. So let's move on to what it does affect. So first, let's talk about long-term versus short-term capital gains. So long-term capital gains, as defined by the IRS, is on an asset that you've held for longer than 1 year. So this is important as the market now goes on the idea that for the last 15 months, we've had some incredible moves in the market. Remember, long-term capital gains are taxed at either 0%, 15%, or 20%, depending on what your income tax bracket is. Now, we'll talk about income tax brackets in a second, but remember, short-term gains, on the other hand, those are going to be taxed as ordinary income. This means it'll go directly to the same tax calculation as your employment income goes to, usually at a higher rate. And again, we'll talk about that in a second. This is one way to manage that tax cost. Know what your cost is going to be, and one way to lower that tax cost is to sell when you get to keep more of your profits. That is long term. Again, be careful with that, but it is something to note as how you can manage it. Next, in regard to your income tax brackets, as I just mentioned, there are ways to manage what that will be from year to year. Again, this is beyond the scope of this video, of certainly a short video, but work with your tax advisor on this. You may be able to make some deductible retirement contributions, you may be able to make some charitable contributions, maybe even some deductible business expenses, even defer income until further years. This is a pretty complex part of this planning piece, so make sure you talk to your advisors on that as well. Excuse me. Another way to manage your tax expenses, as mentioned before, donate appreciated stock to an eligible tax charitable institution. We've spoken about this in many, many previous videos. We even did one of our coffee chats on planned giving last year. So remember, you just make an outright donation of appreciated stock. You can use a donor advised fund. Those are something that we've talked a lot about, something that we should visit if you have interest in that. All of these give you the ability to do good things with your money through charities while also doing well for yourself and managing your tax burden. So that's an important piece. Finally, it's important to know that even in good markets like we've had, markets that have been up over the last year, there are investments that go down. I know there's a certain group of investors that'll be surprised by that fact, but there are stocks that go down, and it happens. And one of the tools we use is by realizing those losses and using them to offset your gains. So again, you have to be very careful in consideration of what you sell and when you sell it. But again, it can help you manage your taxes. So that's just 4 ways. These are the 4 tried and true ways to do it. There are many others out there that we can use, and there's probably many more to come, and with the new laws that are coming about. So again, we've touched on a lot of these things over the past year of videos, so check those out. But again, keep coming back. So remember, tax laws are changing. This video is not personalized tax advice. I'll keep bringing you ideas, but each one of those ideas needs to be reviewed for your individual situation. So please, let's talk about it. Let's go into those details. We're about to enter the second half of 2021. Capital gains is something you're going to hear a lot about, not just about from the government side, but from your own personal account side. So please stay in touch with your tax advisor, stay in touch with me, and remember, it's not what you earn, it's what you keep, and that's the big key here. So again, feel free to share this video. You can also now find these videos on LinkedIn and Twitter, and look for my article in the Voice of Chicago magazine. That's all. Have a great weekend.